So financial plan for the startup companies too. Actually, let's try to discuss this one also. At the end of this lesson, you can understand. Actually, we have already discussed this pro forma financial plan. Once again, we need to discuss and how to forecast sales, receipts, and disbursement, etc. And types of financial statement. What are the financial statements and how to finance your business and venture capital and financial statements. Basically, we have to prepare the pro forma balance sheet, income statement, and the cash flow. Pro forma, that is forecasted one. Determine the minimum cash balance and forecast sales. The minimum cash balance that you must have, and forecast cash receipts, forecast cash disbursements, and estimate end of the month cash balance. At the end of the month cash balance also you have to estimate. The financial plan actually this is the one of evaluation tool of the business. You know that the company's survival depends on this financial plan, and the marketing plan, operational plan, production plan helps for this one. Actually, production plan and the marketing plan is equally important. Unless your product characteristics deliver to the customers will not buy your product. So that definitely you will have the marketing campaign to give the product characteristics to the customers. So for the marketing also you will have to have a separate budget for the marketing budget, and also the production. The financial plan is the combination of all these budgets: the marketing expenses, production expenses, then operational expenses, all must be included with the financial plan. Financial plan is the overall plan about how to use the money in the company for a certain time period. And startup budget, actually when you are going to start the new business, you have to have you have to bear a separate cost for operating budget. Actually ongoing expenses once open, and when you consider the pro forma balance sheet, actually estimate the firm worth on a given date, but on a accounting equation. Assets equals to the liabilities plus owner's equity. Owner's equity means ownership, owner's value. So pro forma income statement actually compares the firm's expenses against its revenue over a period of time to show its net profit or losses. Net profit is the sales revenue minus the expenses. So then pro forma statement cash flow shows the changes in the firm's working capital over a period of time by listing the source of funds and the use of funds. Source of funds and use of funds, those are very, very important. So startup, when you are going to start a business, actually that is considered the brand new business you are going to start. You have so in such case you have to have a startup expenses. That means you have to register the company, you have to rent the place, and you have to pay the key money, you have to pay the setup installation fee for the electricity or telephone or internet, any other services you are going to get. So those are not income generating events. Actually the initial cost, you have to bear a certain initial expenses when you are going to start a new business. So and also in addition to that, you have to have the operating cost also. To operate the business you have to have expenses. So start expenses may include the business registration fee, business licensing and permits. Sometimes you will have to get the license and the permits you will have to pay. Sometimes these license fees once a month, once in a year you will have to pay. And also these are the startup expenses, starting inventory, rent deposits, down payments of the equipment. Sometimes you will have to pay the down payments, utility setup fees, occupants, that is leased, rent and mortgage fees, legal and professional fees. If you want to register the company, you will have to pay for the lawyers to register, and also equipment, suppliers, salary and wages, utilities, payroll, internet, license and insurance, advancing. Sometimes you will have to pay the advertising and promotion campaigns, and project operating revenues, sales revenues and other revenues. The revenues, you may have these types of revenues, and operating expenses, cost for the goods sold, selling and administrative expenses, and also net income before. Then you can calculate the net income before interest and tax. When you have the net income before the tax, you can calculate revenue minus operating expenses. When you are going to prepare a pro forma financial statement, you have to project assets. You have cash, account receivable and inventories, other current assets you have, and investments, fixed assets and other assets. ඔව් මේ යනවත් දැම්ම මට මේ ලෙක්චර් එකක් තියෙනවා තව ඉවර වෙන්නේ නැහැ ඒක තාත් විනාඩි 20ක් විතර යනවා කමක් නැද්ද මම ලොක් කරගෙන යනවා ඔය ජනුටි බාර දෙන්න හා okay then project liabilities actually contributed capital, accounts payable, account payable, notes payable. Actually there are some types of payable notes, other current liabilities, long term debts, and if you get a short term loan, we can see the current liabilities and long term debts and other liabilities. Contributed capitals you can consider while you are preparing the liabilities and contributed capitals. These items actually, sometimes all these are not included in your business, but you have to think what type of expenses and what type of income you may have. The project was financed in income tax, expenses and other charges and retained earnings, and if sometimes you may have to pay the interest, you may have to bear the interest also, income tax and also net income, dividends. If a large shareholder companies, annually they have to pay the dividends and change the retained earnings. So statement of the cash flow may have the investing, acquisition of the fixed assets, sales, investments, acquisition of the investment and other investing transactions, cash flow, investing, cash flow, investing, and operating expenses. Actually these are short term, sometimes the recurrent expenses, for an example salary, rent and mortgage, different payments. For an example, actually all these are the recurrent expenses and payments, telecommunications, utilities and raw materials. Also sometimes not in every month, sometimes that also the recurrent expenses, and storage, yes, If they rent the storage, that also has to be paid. Distributions, the promotions, the marketing promotions and loan payments and office suppliers and maintenance, those are some expenses. Actually, most of these expenses may have monthly, actually normally called the recurrent expenses. And so then sales and other revenues, actually you have to consider this price, general price inflation and inflation, deflation and inflation. Actually sometimes with the economic condition of the country, the price may vary. So you have to bear those things. Actually sometimes you will have to buy some items higher than the previously you buy, and when you are going to sell, sometimes you will not be able to sell at in that time. You may have a certain loss. So specific industry factor affecting demand and excess capacity and storage of raw materials and price of substitute products and sometimes volume, also consider the volume growth rate of the general population. This is actually when you analyze the sales, you have to forecast from this growth rate of the general population. If you forecast the certain customer segment and forecast your sales, you have to think of these things. We will prepare a simple financial plan next week. Then you can understand how to use this thing. Then operating expenses also, projections depends on the behavior of the cost items, variable cost and also high fixed. Sometimes use common size income statement percentage multiplied by projected sales. Actually the income may vary depend on the sales that you forecast for that one. In that case, when you are going to forecast the sales, you have to forecast not in the optimistic, not in the pessimistic. Actually the fairly right on fairly you have to forecast. Otherwise, if you make some optimistic estimation, sometimes you will not be able to reach that one. And high fixed cost estimate and variable cost and fixed cost to the firms. Variable cost they may have as also fixed cost, and use historical growth rate of the individual item. Sometimes when you are preparing that one, you can't make any prediction for an example. Even in the present situation in the world, actually there is a war, Ukraine and Russia, and the fuel price will increase gradually, fuel and gas, and in such case all the items will increase. In such case, very difficult to predict the cost for the items in the future. In such, so you have, if you get the historical prices, that means the price in the previously, you may not be able to forecast correctly. So that use the historical growth rate, and then you can get, if you get the historical growth rate of this increasement of the prices for the individual items, sometimes not 100% accurate, you can reach to a certain extent. Also, this income statement, actually income statement is also called a profit and loss. P&L is a financial statement of companies that indicates how revenue, that means money received from the sales or the product and the services before expenses are taken out and transformed into the net income. The purpose of the income statement is to show managers and investors. This is why we prepare this income statement, that is to show the managers and the investors whether the company made or lost money during the period being reported. Okay, for a certain period of time, you can show your investors as well as managers whether the company is making profit or running at a loss. Income statement help investors and creditors to determine the past performance of the enterprise and predict the future. So using that, they can decide whether this company is going well or else this company will run at a loss. Here I gave you gave you a certain example of the pro forma invoice projected year 8, year 9, 10, 20, and sales. From the sales, other revenues and cost of goods sold and selling and administrative cost, interest expenses and net income before income tax. So when you deduct from this, you can get the net income, and income tax expenses also you can reduce the net income. And if you pay the dividends for the shareholders, you can add it and change the rented earnings. You can see that the earnings of the company. Actually, sales. For the sales, you can give these sales, the breakdown of the sales, the cash sales as well as credit sales, and revenue also. You can give the sources of this revenue. Actually, this is the summary, but when you prepare this one, you have to prepare a descriptive one to understand the company's position. Pro forma income statement also you can show like this: sales, cash and credit sales, total sales, this one, returns, also net sales revenue, this one, cash of goods sold, the materials and labor, wages and other expenses, and total cost for the goods sold, depreciations. If you want to depreciate, sometimes you will have to depreciate the machines, and vehicles. That means if you buy a certain machine for 100 million, if that machine can use 10 years time, within that 10 years you will have to depreciate that machine for the 10 years or 15 years time. In such case, annually how much you are going to depreciate from the revenue. And also you will sometimes, if you buy that one from a bank loan, so you have to have the loan installments also and depreciation. So at the end of the 15 years, if you sell that one, if you get the 100 million and you are going to sell in the 50 million, you can have that 50 million because the 100 millions you have depreciated for the 15 years time. And interest expenses, taxable income and tax, and net income. You can get net income after the tax, and if you pay the dividend for the shareholders and retain earnings, you can calculate like this. And first, I want to tell you, when you are going to prepare the income statement, balance sheets, and because in your assignment, actually, I told you to write a business plan for the startup company. In such case, you haven't a business that has operated previously, so that you are going to start, so that you have to have an initial cost, and you haven't done a business for period of time. In such case, you will have to prepare the forecasted financial plan or the pro forma financial statement. So you can't prepare the profit and loss account, just you can prepare the statements, statements, forecasted sales as well as forecasted cost of sales, and also the income, forecasted income likewise. That's very simple financial plan for your business plan. You will have to prepare the balance sheet. Actually, in the financial account, in the balance sheet or the statement of financial position is a summary of a person's or the organization's balance. Actually, this will prepare for a certain date. Assets, what are the assets, what are the liabilities, what are the ownerships of equity, and listed as of a specific date such as end of the financial year. Normally we prepare the as at 31st March of a certain year, 2022. Likewise, balance sheet is often described as a snapshot of the company's financial condition. This will be the snapshot of the company's financial condition, so that at the beginning of the business you can also prepare the financial statements, not the balance sheets and other things, statement only. Perform a balance sheet. Actually, each prior year's balance sheet item is expressed as a percent of a total assets, and then multiplied by the year forecasted total asset future for the next period. Okay. The items, so it helps the company to see whether the funds will be generated into the coming period and where the funds will be used. So if operation is insufficient to generate cash flow, so what would happen? So you will have to borrow. So you have to then, that's why most of the startups find the investors for that one. Actually, you can borrow from the investors as well. Otherwise, you will have to borrow from the banks. So the business plan is one of an important document that you have to prepare. By given the actual ones, then you will be able to borrow a loan from a bank without any hesitation. Okay. This is some example of the financial pro forma cash flow statement. And also let's now see the method of financing and startup company. So you can use your personal funds. Sometimes your family or the friends will provide the funds as loans or sometimes as gifts. So then and also you can find an angel investor, normally called the venture capitalist, or sometimes the government and some organization provide grants. Actually, grant and loan is different. Grant, if you get the grant, you will not you need not to pay back. And what they expect, if the government give you a grant, the government expect that you will improve your business and pay the taxes to the government. So they expect the money returned to the government in a different path, not like return the money, something like getting the taxes, income taxes and other taxes, personal loan and the business loan. You can get the personal loan, business loan. So I don't want to explain more about the venture capital because I explained the previous lessons, venture capital is a is investment made by the professionals, sometimes professional groups. So institutions also, the venture capital companies also are there. Why they are going to invest in a risky business? Sometimes you might think because they want, rather than investing the money in the bank, they expect more than that they can get as returns. For an example, if they invest the money in the bank, sometimes they can get 5 to 10% interest. But if they invest in your business, and in return you will have to give the equity, or else simply we can say as the ownership, percentage of ownership, not all, the percentage of ownership to the banks, then percentage ownership to the investors, then they can get actually the dividends, actually the profits, as well as after a certain time they can get the money back. That's why the most investors and the venture capitalists would like to invest the money in the venture businesses. So generally made as cash in exchange the equity, as I told you, usually high risk but high return type of venture capitalist. Actually we can find the private one, corporate one, academic also. The universities also provide the venture capital for startup companies, government, and angels also. Maybe they may have some networks. Then I told you how to evaluate your business plan by the venture capitalist in previous lectures. Venture capital investment criteria, the management team, track records, relevancy, and bet on the jockey, not the horse. Actually, I normally call that one. Concept is solves real problems and favorable market dynamics they expect. And so then what they can get the advantage? Actually they can get some advantages when we compare with the banks and the investing in the new business ventures. They compare the profit and the profit that they can get, as well as they can get the ownership of the company. I know one company here in Sri Lanka also. He is one of my student, and now he is running a big business. He found a venture capitalist, and he invested nearly 200 or 300 million to his business, and he gave the 25% of the ownership. Now from that money he could develop the business, and now he is a multi-millionaire in Sri Lanka, actually in a software business. Let's see what is this working capital. Actually working capital, also known as a net working capital, it's a financial metric which represent operating liquidity available to the business. And along with these fixed assets such as plant and equipments, the working capital is considered as a part of operating capital, and it is calculated current assets minus current liabilities. So elements of this working capital: cash, bank balance, short-term investment, and trade debits, inventory, like that we can give. And current liabilities, what are these current liabilities? Trade creditors, bank overdraft, short-term borrowings, provisions for tax, and provisions for dividends also can be considered as current liabilities. So then construction of income statement. Actually these are some, you know that sales revenue is the price into the quantity sold. The gross profit, actually sales revenue minus cost of sales and other direct costs. Operating profit, gross profit minus overheads and other indirect costs. These are some equation. Actually when you go through this one, you can easily understand. Pre-tax profit or net profit, operating profit minus off of items and redundancy payment, staff recruiting and interest payable. Profit after tax means per tax profit minus tax. Retained or net profit after tax minus dividend. Actually, when the company paid dividend from the profit, it will consider as the retained net profit. So cash flow statement I explained several times in this one. And direct and general cost, these are the direct cost, and the general cost, those also I explain. And let's try to prepare a small cash financial statement for the business in the next class. These are the assets actually. That's all for the this one.